In this video, I'm going to go through the issue of the tax saving through the use of non-trade charges. This is something that can frequently appear as an element of a loss relief question, and it has an impact on losses carried forward. So if after using your losses in the normal manner, you still have some losses coming forward to future periods, you will possibly be required to apply the principles which I'll illustrate in this video. So it's tax saving through the use of non-trade charges. Now, just to look at the conditions, the circumstances where this issue kicks into play. So we're looking at a situation where a company has a 396B claim in an accounting period. So it's utilised losses against its taxable income and its tax liability. And at the same time, it's also utilised non-trade charges in that same period. Okay, so it's important to note that we're talking here about non-trade charges. So where you've got both of those conditions met and you have a loss going forward, you need to reduce the value of the loss going forward by the tax saving which arises on the use of the non-trade charges. Okay, so in essence, the tax credit that you've left after utilising your 396B claim will have to be reduced by the amount of tax saved through the use of non-trade charges. So obviously then you need to be able to calculate the amount of tax saved in such circumstances. So I'm going to look at three short scenarios that we covered in class previously, but I'm just going back over them for the purpose of revision. Okay, so the scenarios are as illustrated on the screen here. We've got scenarios 1 through to 3, and you can see we've got some details of income gains and non-trade charges. And we're told in each separate scenario the total income consists of case 3, 4 and 5 only. So case 1 is eliminated in these total income values here. And in scenario 1, 6,000 of the total income is portfolio income. Okay, so we've got 6,000 included in that 20,000, which is portfolio income, and there's nothing in either of the other two scenarios. And you're assuming that the company has a trading loss of 40,000 euros after Section 396A. So there's a very substantial loss, and you can see based on the taxable profits in each scenario that clearly there's going to be some unutilized losses carried forward to future periods. And in each case we've got the use of non-trade charges. So you're basically asked to calculate the tax liability of the company for each separate scenario and calculate then the loss to go forward to future periods. So I'll go through the first scenario. Okay, so just to carry forward the image here. So here's the details of scenario 1. So you can see we've got taxable profits of 5,000. Okay, so taxable profits 5,000 euros. And how's that taxed? Okay, well, 25% on the case 345. So I'm just going to highlight that general formula there. So case 345 is well, the full amount minus portfolio income, which we were told is 6,000 minus non-trade charges. So when you do the maths there, you've got 25% of 20,000 less the 6 that was included in that 20,000 and minus the non-trade charges of 16. So we end up with nothing being taxable at 25%. And then the rest of the income is taxed at 12.5%. So 5,000 is going to be the amount there. 5,000 taxable profits minus the amount already taxed. So the amount already taxed was 0. So 5,000 taxable profits minus 0 is going to be a tax liability of 625. So at this point our tax is 625. Now we have to deduct the excess trade charge credit. There's none in this particular scenario. Remember the sequence of loss claims is important to get right. You've got 243B ahead of 396B. Okay, so we then take our 396B credit claim. Now I've got 625, but just to show that that calculation. So we have a loss of 40,000 available. Okay, trading loss available after 396A claims, and we convert that to a tax credit, which essentially multiply by 12.5%. That gives us 5,000. And how we use that we use it against the current period's tax liability after the 243B. So we're left with 625 being used. Credit remaining therefore of 4375. Now, here's I suppose the key point: tax saving through the use of non-trade charges. We had non-trade charges of 16,000 euros. Okay, so how does we utilize those non-trade charges? Well, the principle is that we set them against the highest taxed income first. So of the 20,000 of income, 14,000 of it is taxed at 25% and 6,000 is taxed at the portfolio rate. So saving at 25%, 14,000 by 25% gives us a saving of 3,500. And then the balance of the non-trade charges, which is just 2,000, we used 14 up here, and that's out of 16, so there's another 2,000 was used to reduce 12.5% income. So the tax saving that we had was the sum of those two amounts. So we deduct those two amounts off the 4375 to give us a revised credit remaining of 625, which converted to a future loss is 5,000 euros. Okay, so so our future loss going forward is going to be 5,000. If we had converted this, you'd be looking at 35,000. Okay, so it's quite a significant impact. And again, just the general point there, the company had a 396B claim and it used non-trade charges. Okay, so it had used non-trade charges to reduce its taxable profits. So we had to apply this principle here. So I suppose this is the particular material that is relevant here, to deduct the tax saving on the use of non-trade charges from the credit available for future periods. Okay, and then reconvert to a reduced 3961 loss. Okay, so that's scenario 1. Much the same principle applies to scenario 2, and I'll just go through that. Okay, so again, just to show the details here for scenario 2, again, here's our details of what we have. We've got no portfolio income this time, and again, we have a very large loss of 40,000 available for conversion to a tax credit. So our taxable profits 8,000, and tax as follows. Okay, well again, 25% on case 345 minus portfolio minus non-trade charges. Well, case 345 is 15. Portfolio is nil in this instance, and the non-trade charges are 7. Okay, so again, I'm just going to highlight that text in red. And then that's 25% of 15 minus nothing minus 7 gives you 25% of 8,000, which is 2. And then the rest is taxed at 12.5%. Okay, so taxable profits are 8, but we've already taxed essentially 8, so it's going to be 0 tax at 12.5%. So my total tax is 2,000. Now again, we don't have this in this question. The 243B tax credit is 0. Okay, so we're still left with 2,000, and then we have to deduct the tax saving under 396B. So again, just to show the method there. Okay, so we have a 40,000 loss, and it's converted to a tax credit, multiplied by 12.5% to give you 5,000. 396B current period, well, our total tax liability in that period is 2,000 euros. Okay, so we can reduce that down to 0 using 396B. So we have 3,000 of a credit left. And again, here we are with our tax saving on the use of non-trade charges. So this time, the non-trade charges of 7,000, they were used to reduce income which was taxed at 25%. Okay, so the saving at 25% was essentially 7,000. Okay, all the non-trade charges went against 25% income. So 25% of 7,000, and nothing was used against 12.5% income. So the total saving was 1,750, which comes off the credit to give you a revised credit of 1,250. And when you reconvert that to a loss for future use, you've got 10,000 euros. So again, I'm just going to highlight this key bit here that identifies the amount of the tax saving that we're talking about. Okay, so we used 7,000 of non-trade charges against high rate income. So we saved 25% of 7,000. And again, just the general point there. We have a 396B claim in the period. We claimed relief for non-trade charges. Okay, you can see we used 7,000. So we had to do this bit that's highlighted in green. Okay, so that's scenario 2, and I will go to scenario 3. So again, scenario 3, here's the details of scenario 3 just for reference. So we've got total income of 10,000, all of which is at the high rate income rate, and the non-trade charges are 4,000. Okay, so we're going to be using those against the high rate income. Okay, so again, 25% on case 345, which is 10,000. There's no portfolio income, so 10,000 minus 0, and then minus the non-trade charges, minus 4,000. So we're looking at 25% on essentially 6,000, which is 1,500. Our taxable profits are 7, and we've already taxed 6, so we're going to have to tax a little bit at 12.5%. Okay, so 12.5% on taxable profits of 7 minus what we've already taxed up here, that's 6,000. So 12.5% of 1,000. So that gives us total tax arising of 1,625. And we deduct, okay, the 243B credit doesn't arise in this question. So we've got 1,625 here. And then we have to deduct the 396B. Now again, I just show the working for that. So our loss was 40,000, converted to a credit, it's 5,000. And set against income tax or corporate tax of the current period, well, the corporate tax was 1,625. Okay, so that leaves us with a credit of 3,375. And because we've a 396B claim and we have utilised non-trade charges in the period, we have to do this tax saving calculation. So we set 4,000 non-trade charges against high rate income. So that meant we saved the tax on that 4,000 of income. So 25% of 4,000 and nothing at 12.5%. So that reduces the credit down to 2,375. Okay, and when you reconvert that to a future loss, you've got a 19,000 euro loss for future periods. And once again, you should know what this is going to say. We had a 396B claim in the period, and we used non-trade charges in the period. So we had to calculate the tax saving arising through the use of non-trade charges. So that completes the revision of this particular topic.